The battle between rates and tech, one keeping the S&P on edge, the other keeping investors buying in. So which will decide the fate of this rally? Let's ask New York Life's chief market strategist Lauren Goodwin and Invesco's global market strategist Brian Levitt, both as you see, are with me here at Post 9. It's nice to see both of you.
Nice to see you.
Lauren, that's what this is about, right? Rates backing up. I said the 2 years near 5%. And the stock market doesn't like it because the Dow's down about 400.
Yeah, we're seeing a little bit of movement this week with respect to rates, but I think this is just the calm before the storm. We're about to set up for a lot of economic data that will skew the investor perspective in one direction or the other. We're getting inflation data on Friday,
PCE,
manufacturing data on Monday, jobs next week. This is an environment where the balance of risks that the Fed is trying to navigate could very well shift over the course of next week.
But you make the argument that the data over the next week is, quote, likely to prove out the Fed's cutting bias and that the PCE is going to be good.
Yeah, I think that
the market doesn't think that.
I think that what the market's been hearing from Fed speakers over the past couple of weeks is that their balance of risks is they're really trying to navigate a tightrope where the economic news has been strong, earnings has been strong. That's why we see some of the tech names really still flying, and that they haven't seen enough progress on disinflation yet. The all else equal there is the labor market. And I do expect that much like in last month's labor market data, we're going to see continuing signs of slowdown, which I think will give the markets reason to be relatively optimistic about that cutting bias.
Brian, we've seen this movie before.
We have.
Right? Markets going great.
Yeah.
All of a sudden, rates back up. Hello, April lows. And then, rates sort of backed off, and we had a rally back.
Yeah. There's an
set up for that?
Well, there's an irony about it because strong nominal growth is good for corporate earnings, and in a strong nominal growth environment, you don't get rate cuts. But investors should probably prefer strong nominal growth and no rate cuts to weaker nominal growth and many rate cuts. So we've spent a lot of this year with the will they or won't they, and when and by how much, how many. Right? And the irony of it is the market, at least the broad market, has done well because we've been in a good nominal backdrop and we've been in a good earnings backdrop.
We've narrowed again.
We have narrowed
right? I mean,
again,
here we are yet again. We're talking about some mega cap names that are driving the bus again. It's Nvidia, it's Apple. I said Amazon. There are a couple of others that were like around the flat line that I didn't necessarily want to mention because I wasn't sure if I said positive they'd be negative when we showed them. But you get my point.
I do get your point. And if you think back to November and December of last year, the market quickly priced in 6 rate cuts and small caps and mid caps. So think of broadening out, had a very quick bull market. I mean, that was what a lot of us had hoped for in 2024, and it all happened in 2 months. Then you had to price out those rate cuts, which again is what we're doing. And as you price out the rate cuts, the smaller businesses that tend to have a little bit more leverage get hurt in that environment. So in order for this to broaden out, you would likely need to see a still reasonably good backdrop, but a Fed that starts to slowly normalize the yield curve. That would be the proverbial no landing or maybe really soft landing that investors have been looking for.
Lauren, it's a funny market. 1 minute it's a good news is good news market, and the next minute it's a good news is bad news market for the very implications that Brian laid out. What it means for the Fed, what it means for possible rate cuts, how many we're going to get, and when. Do you think the market can accept the fact that good news is in fact good news and that rate cuts don't matter because the economy is still good?
I think that we have been seeing that since April. As Brian mentioned, we've moved from an environment over the course of the year where we were expecting 6 rate, or the market was pricing in 6 rate cuts. We've moved to 1.5. And with the exception of a little bit of tumult in April, it's been a pretty easy-going process. And so I think because
rates have come down, right? Rates have come down. They allowed the market to rally back. Now here we are. Rates are backing up again, and the market's, has a couple days where it looks like it's falling apart a little bit.
Here's what I feel pretty confident in that's been swirling around the market in the past couple of days. I think it will be very, very difficult for the Fed to hike rates. And that's not because, 25 basis points higher makes a real meaningful economic growth difference. It's because the signal that sends to the market, it would be very likely to tighten financial conditions. Even the breadth of potential rate hikes, I think, would contribute to a slowdown in the data that'd be relatively rapid.